Scalping is a trading style that many traders like because it is quick and is action-packed. When scalping, it is perfectly normal to take 3 or even 5 positions on a given trading day. I will show you a simple price action strategy that you can use to scalp the lower time frame in today's video. This strategy involves using a trend line and chart patterns like the double bottom or double top. If you have no idea what I just said, then make sure to watch my other videos as I explain each of these concepts in greater detail. By the way, hit the thumbs up button, subscribe to this channel, and turn on the notification bell so that I can help you become a better trader. This strategy involves identifying 2 highs or 2 lows at a critical support and resistance level. The basic idea is that if the market rejects the level twice, then there is a good probability that the level is likely to hold. Just a brief introduction about the double top pattern. A double top pattern is where price fails to break their previous high. It indicates that the level is strong and the bears are in control. Eventually, the bulls tire out and result in a double top pattern. The double bottom pattern is the opposite of a double top pattern. Here's an example where price forms a swing low and then bounces back up. The sellers try to stage another down move by testing the same level but fail to break lower. Eventually, the bears tired out and this results in a double bottom pattern. Now, here's the thing about these chart patterns. They must be validated. Upon validation, it signals that there is a reversal underway. Here's an example of a double top pattern in the 1 minute time frame. You can see that price eventually moves lower after the double top pattern is formed. And over here, we see the double bottom pattern and price promptly trades higher after failing to break the first bottom. Before you get excited about how easy this is, it is essential to understand that not all double top or bottom are high probabilities. You often find patterns that resemble them, leaving you to judge whether it is a valid double top or bottom. Remember, trading is never black and white. A relatively common variation of the double top or double bottom is that it has a fake breakout. Here are some examples of how this looks. Fake breakout patterns are one of the most important price action patterns that you need to learn to recognize. Recognizing them in real time will prevent you from entering the breakout and being caught on the wrong side of the market. It is also a powerful sign that price might be changing direction. A false break of a level can be thought as a trap to induce retail traders to trade in the breakout direction. I have previously covered this concept multiple times on this YouTube channel, so please check those videos out. To apply this simple price action strategy that I'll be teaching you shortly, you need to learn how to use the double top and bottom false breakout to your advantage. A common misconception is that these patterns are immediately tradable once the second top or bottom forms. To clear up any misunderstandings, a double top or bottom is only confirmed and tradable once the price breaks below its neckline. Here's an example to illustrate this point. We have an immediate high being formed in this double bottom pattern. When the neckline is broken, then this double bottom pattern is validated. In this example, you can also see that once the pattern is validated, the price changes direction and starts to trade higher. When combined with trend lines, this can be a very powerful scalping strategy. Most books out there teach you to trade double bottoms and tops as reversal patterns. And while that is perfectly fine, I like to view them as continuation patterns instead. Remember what I mentioned about fake breakouts earlier? Earlier on, I mentioned that we will be combining these patterns with trend lines to scalp the market. I will now provide a step-by-step guide to do this. The first thing you want to do is to determine the main trend on the lower time frames. You want to plot a trend line in the direction of the main trend. If you see higher highs being made, you draw an upward trend line. Conversely, if you see lower lows being made, you draw a downward trend line. The next thing you want to do is identify potential chart patterns. either the double bottom or double top pattern. You want to be sure to identify those that happen close to the trend line. When the chart pattern appears, the trend line helps you stay confident that you are trading in the right direction. Here's an example to drive home the point. We have an upward trend line here on a 5-minute time frame. In this case, we want to be looking for a double bottom that forms near that trend line. This pattern sits nicely at the trend line, and since we already know that the market is in an uptrend, it greatly enhances the probability of this pattern working out. Compared with trading the double bottom in isolation, it should be obvious that this trading method has a higher likelihood of success. You enter once price breaks above the neckline of the double bottom. Once the double bottom pattern is validated, it is important to understand that the initial break of the trend line is not the entry trigger. Instead, it is the retest of the trend line as new support. You can look for a reversal candlestick pattern like the engulfing pattern or piercing pattern of the new support. You might ask, why do we do this and not trade the breakout? Well, by trading in this manner, it ensures a favorable risk to reward ratio, something that is very important if you wish to scalp the market. Remember that when scalping the market, your spread or commission cost will be high, and therefore going for good risk to reward trades is critical. In this example, notice how the market retests the neckline as support before taking off. This is the opportunity to go long. When it comes to setting a take profit, you calculate the distance of the double bottom and project it to the upside from the neckline. Here is another example of a valid double top that occurs near a downward trend line. We have a downward trend line here followed by a double top that sits nicely on the trend line. Notice that price is unable to break above the first top and the trend line. We plot the neckline between the two tops and patiently wait for the price to break below. Price eventually breaks below the neckline, and we watch for price to retest the broken neckline as resistance. Price forms a nice rejection candle of the new resistance level, and that's our opportunity to take a short. Now addressing where to set your stop loss. The optimal place to place your stop loss is above the second top. This ensures that your trade has sufficient breathing room. If you want a better risk to reward ratio, you could also set your stop loss closer based on market structure. It requires more skill, and you need to strike a balance between having too tight a stop loss and giving your trade sufficient room to breathe. To determine your profit target, measure the double top's pattern distance and project it downwards from the neckline. This is your minimum target, but feel free to have multiple targets and lock in your gains along the way. Reiterating a common mistake made by traders, a double top or bottom without a close breaking the neckline is not a valid pattern. Do not jump the gun and trade since the market is still in consolidation. Attempting to enter before or confirmation will get you into a lot of trouble. Here are several more valid double tops that occur near a bearish trend line. Summing up, combining chart patterns and trend lines can be a powerful strategy to scalp the market. It gives you an edge over other traders who use indicators, since indicators are lagging in nature. I hope you learned something useful from this video. Please leave a comment below and let me know what your biggest takeaway was. Leave this video a like to show your support, subscribe to this channel, and hit the notification bell so I can help you become a better trader. I've also prepared a free day trading guide, which you can download via the link in the description below. See you in the next video.